Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management, will be joining us for the hour. And in 30 minutes, Canadian farmers are feeling the effects from the Iran war. Darren Shrewsbury, founder of 33.7, will be here to tell us more about that impact. And we want to hear from you, of course, on First Call. Reach out with your questions on North American large caps, and we'll have Barry Schwartz answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to go that route, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants will be postponed for 5 days following the start of talks with Iran to possibly end the war. Trump also says the halt to attacks are subject to the success of the meetings and discussions. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start bombing the country's power plants. And Bloomberg News is reporting Sony is nearing a roughly $1 billion U.S. deal to sell a majority stake in its home entertainment unit to TCL Electronics Holding as the Japanese company accelerates a shift away from hardware. The transaction would build on a previously announced joint venture that would see TCL take a 51% stake and oversee production of televisions under Sony's Bravia brand. Berkshire Hathaway is investing $1.8 billion U.S. in Tokyo Marine Holdings, expanding its presence in the Japanese financial sector. The investment was made through Berkshire's National Indemnity Unit. The investment will give the firm a 2.49% stake and establish a strategic partnership spanning reinsurance and global deal-making. The agreement includes a 10-year collaboration and limits on competing partnerships in its early years. And now our top line story, oil prices are falling, stocks are surging in the pre-market after Trump's comments on the Iran war this morning. Take a look at that. Look at oil. It shot up, and of course, in March when this began, and now you can see if we went to like a one-day, you'd see it's dropped about, I think, 10%. 5% is what it's sitting at now, but at one point I think it was down 10%. The markets. Barry, come on in here. Thank you for joining us. Barry Schwartz is the CIO and Portfolio Manager at Baskin Wealth Management. One social media comment from Trump.
Well, we all know how Trump negotiates. And if we look back at what happened during the tariffs, he negotiates at a 15 and then brings it down as because the threats are insane, right? Mm-hmm. The threats of closing, of bombing their power plants was going to lead to possibly nuclear war, right? So we're happy that we're going to see hopefully some de-escalation. This is the first sign of, some type of 5-day ceasefire, possibly. So I get it. All my clients, they watch social media, they're watching the news. It just gets worse and worse and worse, and you just don't know how to react to it. And so your brain says to you, get out. But that is the worst thing you can do. And over the last 26 years that I've been doing this, so many crazy things have happened to the world. It always looks like it's going to end. It always looks like we're never going to recover. But you have to remember that stocks price in the bad news and sometimes the worst case scenario well before the news actually impacts the economy. No question. I'm not trying to poo-poo this. These are major things with the Straits of Hormuz. But it's got to be settled, and you have to recognize that. The world is not going to continue like this for very, very long.
And I think we're seeing a bit of a sobering because we also heard from Iran or aspects of Iran, because nobody's really sure who's in charge there, them saying, well, no, we haven't had these talks. And I'm just looking at the DAX, just one example. It jumped on that social media, and now it's dropped down. Hasn't dropped back down, but it was up about, I think, 2%, 2.5%. Yeah. Now it's up about 1.56.
You're always one tweet away from glory or the end of the world. And so, it's really strange to be in this environment where you check your phone and you see groundbreaking news. You don't know if it's real. You don't know if it's true. You don't know if it's verified. Markets react to it anyways because there's all these computer algorithms that are set to watch market movements, watch specific keywords. And so don't let that knock you off course because that is not for long-term investors. That's for day-to-day investors who playing a different game than what I'm trying to achieve for my clients. I'm trying to create long-term wealth. I can't create long-term wealth if I'm making trades every minute reacting to what's going on the news of the day.
Yeah, it doesn't take long to lose your money on that if you're not careful. So what have you made any moves over the last, say, month?
Yeah, no question, we looked really dumb. Not owning gold, not owning a lot of these commodities. But I mean,
gold's back down to 4,500 right
I kept reminding clients that gold is a speculative asset. It really has no economic value. It's a store of value. If the world's going to end, what are you going to do with your gold bars? You're going to hit people over the head with them? Mm-hmm. So what I say to clients is the best way to protect your portfolio is to stick with high-quality companies that have been through bad times before, managers who know what to do. And have we made a few trades? For sure. We made a few movements because we wanted to take advantage of some stocks that have fallen a lot that we thought were very attractive. We recently bought shares of Fairfax. We bought shares of FICO. We bought more shares of Constellation Software. Just the highest quality companies that we can name. Happy to buy more Berkshire Hathaway here, by the way. What a safe company to own. And aside from that, no, not making any. I never make trades based on the news macro of the day because it changes so quickly, and then you got to make dumb changes again. Not going to happen.
And you were saying that they've priced this in already, and I was looking at the CAC Iran. What's the CAC Iran do today? I mean, even earlier the DAX was up slightly. Asia was taking a huge hit, but the European markets earlier were already trading up slightly from what we'd seen.
Well, last night, if you check the futures, the threats of bombing the power plants, that was serious, but the futures didn't react like it was the end of the world. So I think what the market was trying to tell you was this pushes us closer to some kind of resolution because it can't continue like this. And so that's the good news. That's why the markets are rallying. Of course, we're going to see a lot of craziness over the next 5 days and the next 2 years. It's just the way it is. Don't get knocked off course. Focus on fundamentals. We're all really feeling, I mean, aside from what's going on, we're all feeling really good about the economy right now. It's not a terrible situation. No question there's going to be issues now with fertilizer prices, with LNG, with shipping, but that can get settled. And if this ends by the end of this month, I don't think there's going to be much impact of the global economy. Any
worries about with the oil? I mean, we heard reports out of Qatar that their LNG could cost tens of billions. I think 23, 24 billion, I think was a number that was bandied about for the repairs. There's 3 to 5 years to make full repairs. What kind of what's the concern with that?
It's going to lead to higher prices for a lot of chemicals, but hopefully there'll be other countries that will pick up the slack. We'll figure out how to move goods around from different places, start up plants that may have been idled because chemical prices weren't very high for many, many years. So you never know what the next variable is going to be. You don't know if maybe the rebuilding will start and be much faster than expected. I don't know these things. All I know is there's always going to be parts of the economy that are going to suffer and parts that are going to benefit. If we have higher chemical prices, maybe we'll have lower demand and it will lead to lower inflation. Who knows, right? You can't figure this stuff out, and you can't make a decision based on one commodity price movement.
Any aspect of that tempting to you, though?
We're always looking for opportunities. I love to own companies that I feel comfortable that in the next 3 to 5 years, they're going to be selling more of their goods, their products, their services. It's hard when you're dealing with commodities because it's such a boom-bust industry. I'd rather stick to companies that sell products that we can't live without, like Apple and Visa and MasterCard, those kind of names.
All right, we'll wrap it up on that note. There are lots more to talk about, though, with Barry Schwartz, the CIO and portfolio manager at Baskin Wealth Management. Up next, we'll take a look at the markets before the bell. And what a before the bell it's been. Let's see how things are shaping up on the markets. What an interesting morning with the comments by the U.S. president. Take a look at U.S. futures. They are all soaring right now on the comments made by the president, but now we'll have to see what happens with the Iran saying we're not sure what he's talking about right now, but for now it's holding in the green. Dow up by 1.54, NASDAQ 1 point. They're all in around 1.5% right now. Asian markets, though, here's a better idea of what it was looking like heading into today because they're closed. And so this was before Trump made his comments about talks going well. This was reaction to him threatening to bomb Iran's energy infrastructure. So Nikkei off by 3.5, Hang Seng about the same, and the CSI 300 off by 3.25. Then you go to Europe, and the FTSE's still trying to find its way, but the CAC 40 and the German DAX have kind of come back to earth a little bit. At one point, they were up close to 2% each. And it was like literally a rocket ship rise when that announcement from Trump. And I think now they're digesting the news about what Iran is saying. And you can see the FTSE's off by 0.25, CAC 40 up by 0.66, and the DAX up by 1.12. And the TSX, that just shows you what last week looked like. These are all good snapshots of the last little while. TSX off by 1.69%. Energy and some cyclicals were up, but nowhere near enough to offset the hit to metals, and it was a down week after the 2 rally days to start the week. Winners and losers on Friday. Let's see. Orla Mining up 4.5. Secure Waste Infrastructure or Infra up 3.65. America Gold and Silver up 8.8. Or down, I got excited for a second. They were going totally the wrong way. And Abra Silver Resource off by 14%. And looking at gold, it kind of turned around, but now this is down for the overall, but it has kind of bounced back a little bit. It's off still by 4.6. It was down around 4,100 at one point. Silver, though, continues its free fall down to 67. Continues dropping at 67, 61, but it's still going down, off by nearly 3%. And copper, it is up 0.85% at 542, which is low compared to what we've seen over the last few months. And let's take a look at oil. Western Canadian Select, remember this is from Friday. It closed up 2%. Now today, take a look at WTI and see where it is. It's off by 6% and heading down towards 90 a barrel. People, I guess, still optimism about what might unfold in the Middle East with Trump saying that talks are going well. All right, joining us for the hour today is Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management. And Barry, some advice for managing your portfolio and life a little bit at a time of, high market volatility, shall we say, and a lot of uncertainty, a lot of uncertainty.
I always try and stay optimistic. I've tried being pessimistic, and it doesn't fit with my personality, and it's really not fun to be pessimistic.
It's exhausting.
Exactly. So I've tried the alternative. Might as well look at the bright side of life and look for opportunities, and that should be the way to invest as well. I'm always bullish on the markets. Whether the markets pull back, that provides us with an opportunity. Whether the markets go up and we get all rich and happy, that's great too. But in these type of environments, people just say, get me out of the market without any it's like selling your house to the lowest bidder.
You can't just magically do that.
You don't understand that you're owning great quality businesses and saying, just get me out. And so I understand when the volatility hits, to prevent actions like that, you got to put guardrails on your financial circumstances, right? Whether it's, I always tell clients, keep a whole bunch of cash in the bank just in case bad stuff happens and you want the money and you don't want to be selling your portfolio. No one needs all their portfolio in 1 year or 1 day. Or if they do, they should never be investing in the first place. So stay away from margin, stay away from investing in speculative stuff. Don't get caught up in FOMO. Always leave enough cash in your bank, maybe even a year's worth. I mean, these are wake-up calls. It's the same thing that happened during the pandemic. You don't want to be cashing out at the wrong time. Retirees, I get it. I hear from all the time, I'm this age, I don't have very long, I can't live through another downturn. Fine, then don't invest in the markets. If you want to achieve high rates of return, you have to take on risk in your portfolio. Your other alternative is to leave it in cash or to buy GICs, which are not going to cut it. Most of my clients who are retired need 4 to 6% of their portfolio each year to live off of. That means we need to make 4 to 6% returns at least before fees, taxes, and inflation just to break even. You got to stick with the markets no matter how old you are, no matter how wealthy you are. The only thing that's going to beat inflation, beat the cost of living, is put it into productive assets. And that doesn't mean fooling around with speculative gold or trying to predict when the market's going to go up or going to go down. That's what I do. I think that provides us with the guardrails and the comfort. We own great quality companies. I know what I own, so I don't have to blow them out each time there's a crazy world event. And sit on these hands and sit tight.
All right, so why stay away from margins? What's your concern with the margins?
It changes your behavior. It makes you a gambler. No question, when markets plummet like this, I mean, there's so many great opportunities. If you believe we're going to get out of this and things are going to recover, my God, there's a lot of great values in the market. You should be buying hand over fist. But once you add margin to the equation, what you're doing is changing yourself from a long-term investor to a speculator. Interest rates can go up. Your stocks can go down for any reason. We saw that. I've got Constellation Software went down 50% on vibes that maybe it's going to be disrupted by AI, not actual fundamentals.
Yes.
So this is when you do margin, you can get wiped out. So never do margin. And if you're going to do margin, make sure it's you can pay it back in a quick period of time.
And if you're young right now, I mean, a lot of young people are getting into the markets because they're thinking, oh, we're never going to own a house, so they've been investing in the markets. How should they be approaching it as opposed to the person about to retire looking and going, well, I need a more stable income?
Okay, so when you're young, you have the opportunities.
With what's going on right now.
Yeah, when you're young, you have the opportunities to take on a little more risk than maybe your parents or your grandparents do. You have a lot of time to make it up, but you shouldn't just throw all your money into risky speculative stocks. You need to treat no matter how old you are, you should start preparing for your retirement and start preparing to compound growth your portfolio. The power of compounding is amazing, and we have all these wonderful tax-free vehicles now in Canada. TFSA, first home savings accounts. These are things that young people, hopefully they have the money to fill up those type of portfolios and just leave it alone. If you don't know what you're doing, buy the S&P 500 and a little bit of the TSX. If you do know what you're doing, buy high-quality companies, products, and services that you use every day.
All right. And then go back to the older people looking to retire. You can balance it out. You don't have to just go for fixed. You can balance it out, still have investment in the markets.
Of course.
And keep kind of growing that side of it.
And there's a big wake-up call that, of course, has unfortunately happened with a lot of private investments, right? There's been gated, there's been halts of redemptions for mortgage funds, for real estate, for private assets. Don't reach for yield. If bonds pay 4%, that's what safe pays. I'm sorry, if you want more returns, there's lots of wonderful businesses you can buy in the stock market to diversify your portfolio. But just getting into a product that doesn't move the price around doesn't mean there's not risk deep inside that product, as we're finding out now. So I stay away from all those investments.
All right. We'll wrap it up on that note there, but we'll be back with Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management, to see why Canadian natural resources is on his radar. Time to see what's on the radar for Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management. Two picks to start with, Barry. Actually, only two today.
I can bring as many picks as you want.
They're perfect, right? Canadian natural resources. Let's start with that one.
Yeah, so I mean, I really want to focus on the Canadian oil and gas infrastructure. Look how important it is given what's going on. Only a few months ago, we remember the U.S. Extracted Maduro from Venezuela, said we're going to get the oil. Oil stocks in Canada crashed. Everybody had an opinion and a take in how it's going to be so bad for the Canadian oil sands, and then 5 minutes later, the world changes. So I think that's you need to focus on that the world can change very, very quickly, and the narrative can change. For CNQ, I think it's the most important company in Canada, by the way. The most valuable resource in the world is oil. It has significant reserves, decades of reserves. We just don't have the infrastructure to get more of our high-quality oil to safer places. That's going to take time. I hope this speeds up Canada to focus on, oh my God, we have such an opportunity here. Because look at what's going on with the rest of the world.
I think everybody's hoping that. But is there that concern that we're going to go up? Things are going to calm down in the Middle East? And then it's just all going to get forgotten again.
Possibly, but
we love doing that.
Well, if there's no regime change in Iran or if nothing's settled, we could be back doing this dance again in a few years, right? Yeah. How are we to know? What I love about CNQ is I'm not a commodity person whatsoever. I'm scared of owning commodities because the prices are speculative. They go up and down like a toilet seat. We started buying Canadian natural resources in 2022 when oil was much higher than the $60 level. And I've made a lot of money on CNQ, not because oil prices have worked for me, because the company can grow production per share each and every year and keep its costs low. And the world finally recognizes that with all these significant reserves in a safe country where the potential is huge, that this valuation has to be worth a lot more than what it was trading at, like a pedestrian oil and gas company. Ridiculous. So would I advise anybody to fool around and buy CNQ here today? I don't think the TSX is going to have a very good day, by the way, if gold goes down and oil prices go down. But certainly if there was a material pullback on Canadian natural resources over the next few days, we'd be looking to add more. Great business.
Even with that nice little growth we've seen over the last while.
Oh, for sure. I think it's not a cheap stock anymore, but it's certainly not overvalued given the quality of its reserves, its management, its capital allocation skills.
All right. And Apple, things people need. That's your theme.
I mean, I loved the news last week that Tim Cook traveling over to China. It looks like he's mended the fences there. The growth of the iPhone 17 in China, phenomenal rebound. If you're nervous about AI and don't know how it's going to play out, no one really knows. Apple's the best way. If you want to check ChatGPT or Siri or Gemini, you got the phone. It's not spending any money on capital expenditures for AI. It's not blowing its brains out. Its balance sheet is perfect. It has tons of cash. And the iPhone sale demand is huge. And all these apps that we're going to create with AI, they're all going to be on the Apple iStore. This is the best way, in our opinion, to play AI for the long term.
Not a concern, though, that they're not in the AI race and that they could be left behind?
They are in the AI race. Apple is AI. You can't use AI without having an Apple product, more or less, right?
But what if there's something?
Gateway.
What if AI builds something to replace it? I mean, there's always that possibility.
Well, yeah. I mean, there's always lots of possibilities. For now, this is the best device. People are completely addicted to it. We keep seeing ads everywhere telling people to put down their phones now because it's become a pandemic of insanity looking at your phones. But I love owning products where people are completely addicted to, so I'm going to stick with Apple.
Yeah, and people are loving the new one. Sales are doing well last time we checked. Worried that this could be a one-off because they've been struggling for a little while trying to find themselves. They seem to have found it with this one.
The success of the iPhone 17?
Yeah.
No, I mean, if you listen to what Tim Cook is saying, brand new suite of products. The Mac sales are doing incredible. People have to buy, they came up with this cheaper Mac that competes against kind of these Google Chromebooks. That could be a huge win for them. Coming out with, and then of course, the next big thing for Apple is the Siri AI agent. Right, it's going to be your personal assistant doing lots of things for you, making doctor's appointments. Who knows what it's going to do for you? But once that is integrated into Siri, into the Apple iPhone, I think it's going to be a must-have product, and it's going to spur huge demand for sales, in our opinion.
And any competitors threatening it right now?
There doesn't seem to be one competitor that has the type of products that Apple has. No question, there's some high-quality producers in China, but Apple's a dominant player across the board. And with its open-end, closed-end system, it's a phenomenal company.
All right, we're going to take a break there. When we come back, we're going to go to earth, go to ground. Canadian farmers are sounding the alarm on the ongoing fluctuations in energy prices. Our next guest will join us, talk about that impact that will have on your wallet. And our phone lines will open soon for our first call segment, 1-855-326-6266. Send us an email as well. First call at bellmedia.ca. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants would be postponed for 5 days following the start of talks with Iran to potentially end the war. Trump also says the halt to attacks is subject to the success of the ongoing meetings and discussions. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start bombing the country's power plants. Berkshire Hathaway has invested $1.8 billion U.S. in Tokyo Marine Holdings, expanding its presence in Japan in the financial sector. The investment was made through Berkshire's National Indemnity Unit. The investment will give the firm a 2.49% stake and establish a strategic partnership spanning reinsurance, and global deal making. The agreement includes a 10-year collaboration and limits on competing partnerships in the early years. Bloomberg is reporting Sony is nearing a roughly $1 billion U.S. deal to sell a majority stake in its home entertainment unit to TCL Electronics Holdings as the Japanese company accelerates away from hardware. The transaction would build on a previously announced joint venture that would see TCL take a 51% stake and oversee production of televisions under Sony's Bravia brand. And taking a look at the U.S. futures, they are holding steady in the green on the comments made by the U.S. president that talks will continue and there will be no bombings of Iranian infrastructure and energy facilities. So you can see Dow up by 1.55, the NASDAQ 1.54, and the S&P 500 about 1.48 right now. All right, so Trump may have hit pause on the conflict in the Middle East, but it is still affecting energy prices, fertilizer prices, Canadian farmers hit by those costs, and it may soon hit us at the grocery store. Here to explain the hows and whys is Darren Shrewsbury, farmer and founder of 33-7. Darren, thanks very much for joining us today.
Hi, how are you?
Good, thank you. We appreciate you taking the time to talk to us. What is the biggest impact for you right now? Is it fertilizer or is it fuel? Or, I mean, overall, obviously both, but which one are you feeling more of?
For sure. So it's definitely fuel and fertilizer as a combination is pretty much where it's getting slightly tricky. So we're looking at about a $500 per ton increase in urea, which is a part of base fertilizer, and also a $250 a ton increase in dry nitrogen. So overall, that's obviously impacted the cost of inputs for the farmer. And the cost of inputs since the war started is about $40 to $60 per acre. So that directly translates into increased inputs, which obviously is going to trickle down to a more expensive product at the grocery store.
Hi, Darren. Have farmers been able to get more inventory lately? Have they? How is it going to impact them right now? Is there going to be a lag effect in terms of pricing going up, or are we going to see impacts right in the grocery store ASAP?
So I think there will be a lag effect for sure. There's no supply shortage. Farmers can store quite a lot of diesel, urea, nitrogen on the farms. So it'll be good for seeding. So we will get into the field with no problem with enough nitrogen, urea, sulfur, phosphates, et cetera, et cetera. If this price continues to maintain in a high way, sort of at $40, $60 of inputs increasing, it's going to definitely trickle down, but it'll take a couple of months to get there. So we're hoping that things calm down a little bit. And by harvest time, which is at sort of September time, we're back to, status quo, which is not quite as bad as it is now.
And you mentioned the $40 to $60 per acre, I believe that was. Do you know what that translates to a product at the store?
It depends on what product. So is it canola? Is it wheat? Is it a grain or a cereal? It depends, and it fluctuates wildly on which product you're growing. So if you're growing canola or corn or soy, it's going to be a very different price to table. So we'll have to figure that out. So I'm not really sure what that looks like right now, but overall, it's probably going to be about a 10 to 15% increase in base commodity prices, which is good from an export perspective, but not so good for the end user at the table.
Mm-hmm.
What can farmers do to offset some of these costs? Are they looking to improve technology? Are they looking for alternative solutions? You mentioned that there's going to be a lag effect. Is it going to be that material if the straits open up in the next few days? Could we avoid a lot of the problems here?
So I think, history often repeats itself or comes close to repeating itself. Remember when Russia went into the Ukraine for its shenanigans back in the day? We had a similar experience where, oil went up quickly, diesel went up quickly, et cetera, and it stabilized quite fast after that as the global supply market changed and adjusted to the new normal. So we're sensing that this will happen again here. As you know, Canadian farmers are extremely resilient. We're used to taking hockey pucks to the face constantly. So we will find a way around this like we do on most of our challenges. But in the meantime, it's not all doom and gloom. Like the Bloomberg Commodity Index is up 6% year of date. So that's been good. And we're expecting strong exports. The government's been great as well on the canola tariffs. They're down now to less than 15% on tariffs, which is excellent. So well done there. So we're super optimistic for a great season. And I think that the commodity prices will more than offset the input prices.
Very interesting. Are we expecting any further policy response from the government? What are you hearing from your contemporaries? Is there a potential for further cuts on tariffs or some kind of assistance from the Canadian government here?
Yes, there is assistance right now. The Canadian government has been really, really great and helpful for us. They have increased the ability for us to borrow up to $500,000 of assistance money based on input fluctuations. So that has helped a lot of farmers to be able to sort of buffer the current price increases. So we're grateful for that.
Any concerns about potential shortages of products that you need, phosphate, things like that? If either of this were continued, I mean, who knows what's going to happen with it, and if there's extensive damage to some of the facilities that export this, any concerns about supply shortages and then having an impact on crops?
So at the moment, thankfully, I think most farmers who I've spoken to up and down the chain, a lot of prairie guys, they're all stocked up. And we have, as of yet, not found any supply shortages. But obviously, if this continues, yes, we're going to run into shortages. And if there are shortages, then prices will increase dramatically. And that will be a very tricky thing for the consumer because prices will spike fast. So we're hoping that we have enough supply to get into the field, which I said I think we do as a general country, as a general rule. Hopefully this is good by harvest, because if we have severe diesel shortages by harvest, that's going to affect us getting the crop off. Combines are very thirsty machines, and they like to go through diesel at a rapid rate. So we definitely want to get this thing done and dusted, so to speak, by hopefully September.
All right, and I just want one last question before we go. With all these soaring prices, what kind of is this putting farms in danger of closing?
I think that there's a lot of pressure from various different angles that put family farms at risk. This certainly is one of them. Hopefully this is not the straw that breaks the camel's back. And as I said, farmers are extremely resilient. We built this country on our toughness. So hopefully the family farm can bounce back or stay in the fight, so that when prices do stabilize and, canola's up $1 a bushel, that kind of stuff, that hopefully will rescue us, will rescue the small family farm in or around harvest.
Okay, we have to wrap it up there, Darren, but thank you very much for joining us.
Thank you, Roger. Thank you. Have a nice day.
Cheers.
Thank you,
Darren Shrosbury is a farmer and founder of 33/7. Still ahead, an Air Canada Express plane with 76 people aboard collided with a fire truck on landing at New York's LaGuardia Airport late Sunday, killing the two pilots. We'll bring you the latest after the break. An Air Canada Express plane collided with 76 people aboard, collided with a fire truck shortly after landing at New York's LaGuardia Airport late Sunday, killing the two pilots. For the latest on this, we are joined by Bloomberg's aviation and transport reporter, Danny Lee. Danny, thanks very much for joining us.
Roger, good morning. Yeah, this is yet another tragic aviation accident in the US, the third in 2 years. So let me just walk you a little bit of what happened. So on Sunday night, late Sunday night, a fire truck was being given the authorization to go across the runway at New York's LaGuardia Airport, but it at the same time met an Air Canada Express regional jet operated by Jazz Aviation, and the plane collided with the with the aircraft, which had tragic consequences. We now know that at least the two pilots operating the aircraft, have tragically died. We don't yet have a handle on just how many passengers on board were injured. So that's 72 passengers on board and 4 crew operating the plane. But yeah, this is a tragic accident. And at a time when US aviation is under such great strain, and particularly on Sunday night, where there were air traffic control were dealing with a couple of emergencies during the night. So this had a cascading level of consequences. And what we see is yet another tragic accident.
What were do we know what the other emergencies were that they were dealing with? I mean, it's incredible, the idea that there was already 2 going on.
Yeah, well, basically, the other emergency, it all really revolved around another aircraft, which you could hear on air traffic control, that air traffic controllers were responding to. And actually, in fact, it's potentially why this fire truck was responding to another emergency. But of course, when you look at some of the horrific images and video that has been circulating on social media, such as the damage to the front of the cockpit, which has basically disintegrated, and the first couple of windows as a result, where the galley would be, and obviously at least one of the cabin crew. So you could see the kind of forceful impact that this aircraft took late on Sunday night, especially during a time there was some bad weather around.
All right, and now LaGuardia, a busy airport. What's the impact on just the operations and beyond?
Yeah, LaGuardia being one of not just New York's, but one of the country's busiest airport for domestic travel, it has at least been closed up until 2 p.m. Eastern. So that it actually involves around 500 flights so far on Monday being disrupted, cancelled in the main. But yeah, at a time when the U.S. Aviation system is under strain, particularly around funding for airport security staff, the huge queues we have seen, and then the broader emphasis from officials to try and modernize the aviation system, the infrastructure, and to make it safer. There are a lot of questions for officials on this accident, and particularly as there will be an investigation getting underway to try and identify the causes of what happened in this latest fatal crash.
All right, Danny, thank you very much for that update. We appreciate it. Bloomberg's aviation and transport reporter, Danny Lee. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets. All right, let's take a look at some of the notable calls from analysts and recommendations for the day. And we have a big one. JP Chase and Company strategists cutting their price target on the S&P 500 index, saying the upside potential for risk assets is more constrained by a war in the Middle East. Strategists led by Fabio Bassi slashed their year-end estimate to 7,200 points from 7,500. Geopolitical concerns and higher energy prices for longer will drag global growth lower and inflation higher, Bassi wrote in a note to clients published on Friday. We recommend investors to stay invested with downside hedges in equities, and we hold to these hedges given the modest correction year to date. The firm's new target still implies an 11% gain for the S&P 500 between Friday's close and the year end. Now, earlier this week, JP Morgan strategists said investors were failing to price the potential economic damage from soaring energy prices and other strains caused by a prolonged shutdown of the Strait of Hormuz, despite the fact that 4 out of 5 oil shocks since the 70s have led to a recession. For more on this, let's bring in Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management. You're nodding your head in agreement.
Well, no, I have no idea. I mean, I give kudos to people that somehow know how to predict the future. Because in the short term, because it's near impossible, right? You can make a note on Friday, and Monday the whole world can change, and oil prices can collapse. Okay, let's look at the price of oil right now. It's $90 a barrel. In context, that's not very, very high.
What are we at now? Yeah, we're actually 88, below 89.
Yeah, so, okay, we reached 120 in 2022. Before the financial crisis in 2008, oil was well over $100 a barrel. And that's pre-adjusted for today's inflation. So I don't think the price of oil and commodities is going to break the back of the economy at these levels here. Certainly if they spike higher and stay there at a long period of time, it's going to be an impact. Yeah. But listen, if you can get 11% return on the S&P 500 this year, you're going to be very happy. That comes after many, many good years of stock market success. I'm going to say this. The TSX last year was an anomaly. The move up of 30+% does not make any sense. It's all based on gold and commodity price movements. That can easily reverse. Don't get caught up in that. I think the TSX is a very bad index to index, so to speak. No question, we all have FOMO from missing it last year, but it can, if price of gold continues to go down, if oil stabilizes here, you're not going to have good returns from the TSX. I would stick with the S&P 500 if you're going to index. 500 of the best companies in the world, very well diversified. We just don't have enough critical mass in Canada of high-quality companies. Most of them are very commodity or cyclically oriented, and it doesn't make sense to have the entirety of your portfolio in Canadian stocks.
All right, we'll leave it there. Barry has spoken. When we come back, Barry Short, CIO and Portfolio Manager at Baskin Wealth Management, takes your questions on First Call. All right, time for First Call, and that belongs to Bill in Bowmanville. Bill.
Thank you for taking my call. Barry, I'm sure you've had this question a lot. Constellation Software, you're high on it. I know that's a tough question to answer, but how low do you think it can go? Thank you.
Stocks will fluctuate, and
yes.
The volatility in stock prices should not scare you out of investing. Even the best companies in the world drop 50% more. I remember Netflix. I mean, one of the greatest businesses that we own.
Yeah.
The stock fell 80% in 2022, right? And then it recovered. So focus on the fundamentals. Ignore the stock price. Don't let the stock price be your guide to research if you're a long-term investor. Use it to your opportunities. When valuations get excessive, trim some. When the stocks get cheap, buy some. Constellation Software is at the cheapest valuation that I've ever seen it since I've started buying the company. Yet the fundamentals are improving and actually accelerating. The company is buying new software companies hand over fist. I think there's a lot of misleading information out there in the social media about software.
Right?
Yeah. Maybe if we reach this artificial general intelligence, it will be very bad for software. I don't know. Maybe if aliens come down and take us off the planet, that will be bad for the stock market too.
That took a turn there.
Yeah. No, but you can't predict.
Yeah.
Those times we don't have the ability to figure it out. So as a long-term investor, what I do is I don't know the future any better than anybody else, but what I do know is great companies that know how to allocate capital will surprise you. Berkshire Hathaway started as a textile company and now worth $1 trillion.
Yep.
So companies adapt. Apple didn't have the iPhone when it went public, and now it's one of the world's largest companies. Stick with Constellation. They know what they're doing.
All right. And does Berkshire still have that textile mill?
I don't think so.
All right. That was a random.
I think it was suit liners, by the way.
Interesting. See, the way you make money, right? Okay. Email from Natalie. Good morning. I'm interested in hearing Barry's thoughts about Ferrari in light of the recent, quite the pullback. I didn't realize it pulled back as much as it did. You told me.
Lot of headwinds to the story right now. Right now, they've stopped shipping Ferraris to the Middle East. No question. I mean. Yeah. No one's even traveling there. You want to accept a delivery of a car. That's one of their fastest growth areas, right? A lot of oil money, a lot of rich money moving there. So that's a problem. That's going to impact sales. The other issue, of course, is Ferrari's managing its distribution. It really doesn't want to become a mass car maker. As we know, it limits how many cars it produces. And so as a result, because of great sales after the pandemic, it needed to reset, slow down, and that was really what upset the stock. And so the company's still guiding for tremendous growth, great capital allocators. The valuation was never cheap. It's still not cheap, but this is one of the cheapest valuations I've seen on the company for what we think is a multi-year runway of growth and terrific capital allocation.
People still want the Ferrari red, don't they?
I don't. I'd rather have more Ferrari stock.
Okay, there you go. It's from red stock, I guess. Okay, email from Daniel. Would you buy Thomson Reuters today, or do you have a better alternative pick?
Yeah, I do. I mean, Thomson Reuters is caught up in this downdraft with Constellation Software, as well as other data providers. We're trying to figure out if AI makes all knowledge and all data useless because it can get it itself. Reuters will argue is we have proprietary databases. We have scoured and collected all this information about law cases and taxes that we know that you're going to still want to use and trust our sources versus AI, which can make stuff up. We started buying shares of a company called FICO. We started buying Moody's. We own more MSCI. We like these companies that have proprietary databases and are kind of like the book of record for regulatory industries like financial services that will never trust AI to do all of their stamp of approval type work.
So, yes, you got something.
Yes, the answer is I think Thomson Reuters is probably quite attractive. I think a lot of software companies are very attractive here. They're all buying back stock like crazy. You've seen the announcements. Either you trust the internet and social media or you trust what management is saying. I'll stick with management for now.
All right. And on that note, we'll end it. Barry, thanks as always for joining us, sir.
Thanks for having me.
All right. Barry Schwartz, CIO and Portfolio Manager at Baskin Wealth Management. Lindsay Biscaya is up next with the open. Trading gets underway in a little more than 30 minutes from now. Have yourself a great day.